you've highlighted the two probably key momentum indicators at the moment. Semiconductors earlier on and how China's playing it, and now oil. And I think oil, like you said, is very interesting to look at the longer term. Early in August, you had oil being pushed down by supply. The US really putting pressure on the largest suppliers to increase production because they're worried about inflation. More recently, you've had the worry around growth from the largest engine, that being China, putting pressure from the demand perspective. So we do see, even though we've had this recent, like you said, nice jump, we do see further pressure on the downside. Our house view is $60 per barrel. Is it better for equity markets or not? I think that's a very divergent question in the sense that some economies, particularly Asia in general, see a lower oil price as constructive, whilst other regions will see it as less constructive. Generally speaking, we think our region should benefit from a lower or slowly declining oil price.
So you've got a $60 a barrel target on WTI, so in which case further downside from here. So is this sort of a classic self-correcting cycle coming into play here with what we've seen with oil and some of the other commodity prices? And does it also therefore lend support to the whole argument about inflation being transitory?
Exactly. Inflation is a game changer, right? Inflation is really trying to understand how the central banks, which have been the biggest player in markets for the last few years, are going to play. And on oil, we do think that it's going to be driven by demand. So demand is going to be driven by the reopening trade and how the world manages COVID. And we're starting to see some signs of that slowly repairing or finding its feet. I mean, the change to the Delta variant cases, or the Delta of the Delta, if you would, is starting to slow down in certain regions. And as such, we do think the reopening trade will still remain. We do see normalization from the Fed, but in a gradual manner. And to us, that implies that inflation is likely to not run away. It's going to moderate maybe for the next few quarters, enough that it's going to cause central banks like the Fed to take action, but in a gradual manner. And for that is the most constructive environment for equities given the valuations. An environment where the Fed sees taking off monetary policy because the economy can stand on its own 2 feet is constructive for sectors in the equity market which have still lagged.